In the 19th century, the relationship between the state and financial markets was complex and evolving. Traditionally, we think of this period as one of classical liberalism, where markets were mostly free and states played a limited role. After World War II, the idea shifted. Governments believed that regulating markets could stabilize the economy and encourage investment in real industries. This was called embedded liberalism, where states controlled finance to prevent risky speculation and promote growth. But by the 1980s, a new view took hold. Less regulation meant more growth. The belief was that freeing markets would lead to more wealth creation. In France, around the 1830s, ideas about finance went beyond just making profits. Finance was also seen as a tool to solve political and social problems. People from different backgrounds, politicians, bankers, workers, looked at finance as a way to address challenges like industrial growth and political stability. Finance had the power to gather large amounts of money that neither the state nor individuals could access alone. This made it attractive for funding big projects like railroads and city improvements without burdening government budgets directly. Under Napoleon III in the 1850, the French government actively used finance to guide the economy. They supported joint stock banks like Crédit Mobilier to fund infrastructure and tried to steer investments into important areas by influencing market behavior. This approach was different from simply regulating or deregulating finance. It involved shaping how private investments were made through state actions, even before modern economic planning took hold. Efforts to use finance as a political tool were not new. Earlier attempts included John Law's financial experiment in 1720 and the assignats during the French Revolution, both aimed at solving big financial crises, but with mixed results. What made Napoleon III's time unique was that finance extended beyond government credit to a growing market of corporate stocks and bonds. More joint stock companies were allowed, which shifted French capital markets from public debt to private corporate securities. By 1869, private companies dominated the financial market in France. This rapid growth created new challenges for how the state and markets work together. In summary, 19th century, France shows us how states can actively engage with financial markets, not just by regulating or leaving them free, but by using finance strategically to achieve political and economic goals. Understanding this history helps business leaders see that the relationship between government and markets is always evolving, shaped by both political aims and economic needs. Please like, share, and subscribe.